Good afternoon, everyone. My name is Jon Meyer. I am here today to talk to you about tax planning for investments in retirement. I see people jumping on, so I'm going to get started. As we get going today, I want to start with the first thing, which is from our lawyers to make sure everyone is reminded that the information we're going to share today is going to be somewhat general in nature. So please don't run off and just do everything unless you consult with your CPA, your financial advisor, whatever. There are plenty of opportunities here for a lot of questions to come up. If at the end of this today you want to talk further about some of this with me, you're welcome to do so. Just shoot me an email. I'm at jmeyer@bgm360.com. You can do that if you'd like, and happy to get on the phone with anyone and chat. Today I'll be your speaker. Some months we have multiple speakers. Today I'm the only one. Today I'm going to focus in on the topic at large, but I just want to remind everyone that we do have many other services within the firm. If you need specific services around anything else, please feel free to reach out. So with that, I'm going to start today's agenda. Today's agenda is geared specifically towards taxes. And if you think about it, kind of the distribution phase of life. If you're on this call and you're already in this phase, this is an important question. But if you're not in this phase yet, part of the answer is you need to start thinking about this stuff. And ideally, you're thinking about this stuff 10 and 20 years ahead of actual retirement, because the way you set up your investments will actually impact what happens in retirement. So if you're already there, might be a little late, but for people that aren't there yet, maybe you can make some shifts. So today's agenda, I'm going to have a start with just some of the newest updates to make sure everyone's just aware of where things lie today. I'm not going to get into politics and what may or may not happen. Suffice it to say, this year there is going to probably be some sort of major tax bill that gets brought up, I'm guessing, second half of the year in Congress, but we will find out. We'll move on to some strategies and get into how to manage tax brackets a little bit more. So as we go along, we will cover everything on today's agenda. With that, let's get started. The newest updates are around a couple areas. First and foremost is around the required minimum distribution changes. And for those of you that are following this closely, you may have been told by us or someone else recently that the required minimum distribution age has changed. So for those of you that aren't aware, that is the age where you have to start taking distributions out of your IRAs, 401k, 403b, things like that. Starting in 2023, the age shifted to age 73, and over the next 10 years, it's going to basically shift up to age 75. The second thing they did with this is they lowered the penalty for messing up and not taking a distribution. So they've lowered it from 50% down to 25%. Could go as low as 10 if you correct it quickly. This is a big deal for people that mess up, and half the time mess ups occur, sometimes not even for your own reason, but you just your advisor may have screwed up, or who knows what can happen. The second thing is they changed the RMDs on Roths now. So starting in 2024, you don't have to take a distribution from a Roth if it's inside a 401k or a 403b. Again, a new change. Third, there's a new catch-up contribution for workplace retirement plans, meaning 401k, 403bs. If you're 50 and older, that's now $7,500. If you're over 60, and this is the big shift, from 60 to 63 now, you can jump that to 10,000. And that's new as of January 1st of this year. So that's a new deal. There is talk about expanding that. Who knows if that'll happen. And then finally, there's some new 529 plan flexibility that we wanted to just bring up. Really what this comes down to, For people that put money into 529s and have excess funds, you can now roll over 35,000 from a 529 into a Roth IRA for that child. You can't do it all in the 1 year. You have to do it subject to 529, or I'm sorry, Roth IRA limits. So each year you can put in roughly that 7,000. So basically over a 5-year period, you get the 35 in. So all that stuff still applies, but it is a way for you to shift some monies into a very tax advantaged account for the rest of their lives. So I bring that up just because we are seeing some 529s that are just overfunded. So it's kind of a new cool way to do it. Now let's talk a little bit more theoretically about taxes, because I think people kind of forget what we're trying to do. And before I jump into the hard numbers of tax bracket management, I just wanted to throw an example out there. This example really gets into what happens when you think about rate of return. Most people think about rate of return as, well, this is what I got. But the reality is that's not what you keep. And if I really wanted to be honest with this slide, you would also subtract fees and inflation from a here's what you keep scenario. But the difference between the 12% tax bracket and the 22% tax bracket on this slide is about $7,000 in tax, which is really 80% higher taxes if you look at the hard dollar amount. And that's an important point to make. I think people kind of stop thinking about how much of a difference shifting into a certain bracket can cost them. And so they make decisions without understanding that long-term ramification. As we get started on that, it's important to understand where you sit in the tax bracket. So I'm going to use as an example this second line here, and I'm just going to assume a married couple. If you're married, by the way, if you're on the call and you're single, you just go to this second column and you can use those numbers. But if you're married, taxable income joint, you can go up to 96,950 in income and stay in the 12% bracket. But as soon as you go over that, your next dollar jumps up to the 22% bracket. Now keep that in mind. That's the next dollar. It's not the whole amount, because the first 23,000 was at 10%. The next chunk of money was at 12%. So it's a progressive thing, but it does move things into higher brackets. This is going to come into play later in a slide where I talk about how to take distributions from IRA and 401k plans, because what we see a lot of people doing is they take large distributions in a year and they push themselves into these higher brackets when they could have maybe split that and taken part of it in 1 year to keep it down here, and then the other part the following year keep it down here, and you pay a lot less tax. So this does come into play. The other things, and I'm not going to get into this too deeply, is depending on where you're at, you can trigger the 3.8% Medicare tax. There's another small 0.9% tax as well. So you can kind of move these rates up a little quicker than not by triggering these extra things. I'm not going to get into that this slide. There is another slide on that. But this slide is going to be kind of the focal point for the rest of the presentation. So kind of take a snapshot in your mind of where you lie on this, because the goal, if you're lying any one line, is to try to get you down below that line to the next one down, obviously. So that makes sense. Now, capital gains operate a little bit differently. Capital gains operate at slightly different numbers, as you'll see, and it's pretty lots more streamlined. So basically, most people don't get this in this bracket and get 0% capital gains. Most people are going to be paying at least 15%. And then if you go over this number, you actually jump up to 20%. There could be this 3.8% Medicare surtax that occurs. For example, if you're married, go down to this fine print. If you jump up over 250,000, this 3.8% kicks in. What's interesting about this is this stuff gets indexed every year for inflation, whereas these Medicare surtax numbers do not. This 250 has been in place for many years, and it isn't changing. So if you look at capital gains overall, you'll pay somewhere between 0 and 23.8 on the high side. This does not include Minnesota. Minnesota is on top of that. So for people selling businesses or taking large capital gains, they can pay over 30% in capital gains tax, which brings me to Minnesota. At the Minnesota level, the income numbers are a little bit different. Again, if you're a joint, they're gonna go up differently here, so you got to pay attention to that. And then these are your tax rates. For a lot of clients, we're probably talking about 7.85 and maybe 9.85 on the high side as the tax rates a lot of people pay. So keep that in mind when you think about it. In Minnesota, because there isn't a separate capital gains rate, this applies to both income, normal income, as well as capital gains income. So keep that in mind as well. Jumping to a different federal issue, I'm just going to talk briefly about estate taxes. I'm not going to spend a lot of time in this presentation on it, but it does come up. We do have separate presentations coming probably, I think it's this summer. So watch for those on estate tax. But the general answer right now is that at the federal line, federal number, you can basically die with 13.99 million. Last year was 13.61 per person and not pay any tax. That's generally the answer. So if you think about a married couple, that's a little over 27 million you can protect from estate tax. The second part to that is it's portable. So if you don't use all yours, if let's say the husband passes away, his spouse can use all of hers plus whatever he left behind, as long as we claim this portability within 9 months of your passing. So we do have to make sure we file a tax return and stuff and claim the portability. I say that because that gets missed a lot. We've seen enough scenarios where people didn't file that tax return because they didn't have a tax problem at that point upon the first death, and then they can lose the portability. So keep that in mind. I'll also point out, by the way, at the state of Minnesota level, we'll get to this, but state of Minnesota does not have portability. So it's just at the federal level. If you go over this 27 million roughly, then you pay 40% tax rate. So from that standpoint, it can be quite onerous. So we typically want to figure out how to get people out of that if possible. And if you're over this, then oftentimes we're talking about gifting even while you're still alive, potentially. So there could be some opportunities here. And then finally, just one other tax consideration that is not part of the estate tax question, but we get into deductions a lot. And standard deduction right now is 30,000 for joint filers, a little more if you're over 65. Okay, I bring that up because as I get into the next slide, if you're going to itemize, because you don't want to use that standard, typically what I'm going to tell you is itemized deductions aren't as valuable as they used to be. The one that still is charity. So from a charity standpoint, we oftentimes will find that people are going to go with a standard deduction unless we gift a lot to charity in a year. Again, there's a slide later in the presentation about how to do this, so I'll wait for that. But that's probably the one line most people can control. And I say that because after 2016, and again, some of this stuff is going to come up in a new tax bill here, but in 2016, when President Trump's tax bill passed then, this all changed. And if you remember, it took away all the SALT deduction, which is that state and local income tax. And so now it all caps out at 10,000. So people with high property taxes, high state income taxes lose out because it caps out at 10. And that's why I say charity is oftentimes your one thing that can push you above the standard of 30,000. So with that, I'm going to jump to back to Minnesota, since I talked about federal gifting, I'm going to talk about state. If you're here in Minnesota, and this is going to vary because I know there are people on the call from other states, so take that into account when I say this. But in the state of Minnesota, we don't have a gift tax. So federally, in 2025, you can gift up to 19,000 a person or 38,000 married, and you can do that free of state and federal tax. If you go over that, because everyone says, well, I got to worry about this. But if you go over that, what you're doing is you're going to file a gift tax return and use up part of that 13.99 million federally that you just can say, well, I'm going to use it now instead of waiting till I die. Because that is what that is. That 13.99 I mentioned 2 slides ago is available while living or at death. And so if you go over this 19, you can go ahead and use up some of that, particularly if you're not going to go over it anyways. But at the state level, there is no gift tax. You can give away millions of dollars today and have no issues. You don't have to file a gift tax return or anything at the state level. The issue at the state level is simply you have this 3-year gifting rule so that those gifts, basically the person that makes those gifts has to live 3 years. If they live 3 years, great. If they don't, those gifts can get pulled back into the estate. So keep that in mind. The second point I want to make is if you do this while living, you have no big issues. But if you die, then you do have an estate tax problem because instead of 13.99 million, Minnesota decided to uncouple from that back in 2020 and set it at 3 million. And so here in the state of Minnesota, we can only give away 3 million at death. And after that, you start to have a sliding tax scale between 10 and 16%. So I just bring it up because sometimes it makes a difference when you do the math as to whether or not you should just give assets away while living yet versus doing it at death. And that's going to depend on what state you live in and then potentially what the federal answer is too. This all gets complicated, but that's what the tax system is, right? Let's jump into some strategy. Now that you at least understand the brackets, hopefully a little bit, and what's going on, let's talk about some opportunities that arise. So from an opportunity perspective, we want to think about how to harvest capital gains at the 12% income tax rate whenever possible. Now, if you remember when I showed you that tax bracket chart, if you're married filing joint, that basically is anyone up to $96,000 of income. So if you can fall underneath that 96,000, you can actually get capital gains out at 0%. If you remember the capital gains chart, that's the win. It's not doable for a lot of people, but I bring it up because that can be a nice win. And I also bring it up because sometimes people in any given year might decide to pull more money out of an IRA or do something else that without even thinking, they trigger a higher bracket and then they lose this opportunity at not having to pay capital gains. So always should be something looked at. Second thing is maximizing anything tax sheltered, whether it's retirement plans, health savings accounts, whatever it might be. If you're working in a big corporation, there might be a deferred comp plan. These are opportunities to move income away, because when I showed you those tax brackets, that bracket is not on all income, it's on your taxable income. So you get to deduct from taxable income things like these deductions. So keep that in mind. Take your gross income, subtract some of this stuff, and then all of a sudden you have what's actually taxable. So these kind of things can help. Now, I'm going to go and do the opposite of what I said in point 1 and point 3. Maximize tax brackets. Once in a while, not once in a while, often what we find is if you're going to be in a certain tax bracket today, that you might be in a higher bracket tomorrow. Oftentimes it would be better for us to maximize the bracket you're in today. So for example, let's pretend that on average, you're going to be in the 22% tax bracket today, but you know that in retirement, after you start taking Social Security, maybe a large pension, maybe you're going to inherit some dividend income kind of investments. All of a sudden, you might go from a 22% bracket up to 24, 28. You'd start going over 30. And so you look at it that way, and you might say, well, since I know I'm in 22 today and higher in the future, what I should do is I should maximize the 22. And even though I'm just barely in it, I'm going to pull more money out of my IRA this year and put it all in this 22% bracket. So sometimes that makes sense. Not sometimes, a lot of times that makes sense. And I think a lot of people don't think about the idea of paying taxes early as a smart tactic, but in reality, it can actually, over the lifetime of your income, smooth out the tax savings and overall pay a lot less tax. If you think about it from the standpoint of time and think about it as a family tax bracket, it saves the whole family money. Fourth bullet point. Is there any opportunity in low income years to do anything unique? The easiest example I can give of this is whenever we see things go bad in the economy, and who knows if we're going to see that this year or not, but when we see things go bad, we see people's income drop for whatever reason. And oftentimes, what we'll see is business owners' income drop. There are times where I've seen business owners go below zero for income because they had bad years, especially in 2008, for example. You saw that a lot. When that happens, those are opportunities to do things differently. And one of the main things that people should be thinking about is how do we accelerate income into those years? So a perfect example is if you have negative income, if you do a Roth conversion and pull money out of the IRA, transfer it over to your Roth, you'd create taxable income, but you could do it while you're down at under zero and really have no tax due. I'm not going to get into every detail around that today, but it's those kinds of strategies that I think get missed a lot because people aren't thinking ahead of time. You have to really think about these things at the, not, I guess the latest is December 31st, but I think in October is when people really should start thinking hard tax planning. Ideally over the summer already, if you know things are happening, so that you can prepare for these kinds of issues. Stock option exercises becomes an issue. If you have highly appreciated assets that are income generating, sometimes giving those away to your children or grandchildren actually lower your tax return. If you don't need the money, that could be a really interesting idea. And then one thing we see a lot of, by the way, is this idea of tax exempt bonds. When we create bond portfolios, oftentimes what we see is people are sitting in bonds that pay off a lot of income and basically are jacking up the taxes. And if we just change that to municipal bonds, we can lower the income. If we still want other kind of bond assets, we might put those in IRAs or somewhere else. So we can still have access to that asset class. But I think a lot of times people kind of forget about the trade-offs that come with higher income and what that does to the tax return. Those are just some ideas to start with. I'm going to go through a few examples of some other things. So one of the things that people kind of forget a lot about is what happens when you have an investment that's doing two different things. And I'm going to use a mutual fund as an example. There's two different things going on in a mutual fund. A lot of us have mutual funds. Basically, what you have is you have the mutual fund itself just hopefully growing. And in growing, I'm going to point this out in this example. We have two examples, a fund A and a fund B. In the first one, we have more capital gain growth in it than we do in the second one. But then the other thing we have to worry about is year in and year out, it kicks off income. And so in the first one, it kicks off 21 cents versus in the second one, it kicks off 48 cents. Okay. So let's pretend that in this one, we have higher long-term gain. In this one, shorter long-term gain. In this one, lower current year income. And in this one, higher current year income. On December 16th, you're going to get these dividend payouts. So your decision here is got to be before this December 16th ex-dividend date. Okay. So if you do the math, your taxable income in this scenario is 3,052, no matter which one, because of what's going on. Okay. The tax due, though, is different because the tax due on this income is taxed higher than this. So what we want to look at is, where is this all coming from? And what we want to think about here is the tax due, if we keep the fund, because of this number is $866. In this scenario, if we keep the fund, it's $1,100 because of this number. And by the way, I'm using these tax rates in my calculation. However, if we sold the fund, we'd create $1,100 of capital gains. That's because of this number. And in this scenario, we would also create 1,100. But in this scenario, what's the smarter answer? If we keep the fund, we pay more tax than if we sell the fund. In this scenario, if we keep the fund, we pay less tax than if we sell the fund. This becomes the question of all investments. And it's something that has to get looked at every year. Does it make sense to hold on to something or get rid of it? What are the ramifications on your tax return from the current income versus capital gain income? So it's a great example of what's going on, and this needs to be applied across all your investments. The second thing to point out, because I mentioned it, was Roth IRAs. Oftentimes we will talk to people about doing Roth IRAs, particularly from the standpoint of conversions, where we have lower tax years and can get money out of the IRA into the Roth. I'll talk about that on the next slide a little bit. But basically, just so everyone understands, I want to level set. An IRA basically is pre-tax, and you don't pay the tax until down the road somewhere when you start retiring, which obviously at age 73, you have to start taking minimum distributions. The Roth, on the other side, is post-tax. So you're going to pay taxes before you get the money in the Roth, but then it grows tax-free the rest of your life. So you can pull the money out whenever you want, not pay taxes. If you do the math, if you're in the same tax bracket today as you will be in retirement, these all other things out, all that being equal, or I'm sorry, if the tax rates are the same in now versus retirement, these things are equal decisions. Whether I pay 15% in tax here or 15% in tax there does not matter. So the reason one makes sense over the other is when we know we're in higher brackets, this makes sense to maybe take a deduction. And when we're in lower brackets, it makes sense to maybe go this route because we pay less tax since it's got to be paid before we put it in. Now let's get into that a little deeper. If we want to just do a Roth IRA or a Roth 401k contribution, here's your limits for 2025, okay? And there's a catch-up provision if you want for people over certain ages. But the other side of this is we do have to think about Roth conversions. Roth conversions, going way, way, way back in the tax law, are basically allowed for anyone. There's no income limits or anything like that. Any one of us can do it at any point. I'm going to bring back my point I made earlier. The time to do a Roth conversion oftentimes is when you know you're in a lower bracket today than later, but there's a second time it can make sense. The second time it can make sense is even if you're in a high bracket, it could make sense if the markets take a tumble, because you could convert a bunch of income, yes, at a higher bracket, but then when bounces back, when the markets bounce back over the next year, 2 or 3, that whole bounce back basically comes in tax-free because you're not, because you already paid your tax. I bring it up because that can be a powerful tactic if people are willing to stomach the tax being paid, simply because of the volatility of markets. If they drop fast, sometimes they come back fast. So that's one deal. The second thing to consider in this is this idea of a backdoor Roth. So sometimes people can't make contributions to their IRA or something because they've, or I'm sorry, can't do a pre-tax IRA because they've got a retirement plan at work or whatever. There's other rules around this. So what we sometimes will do is have them make an after-tax contribution to an IRA because they may not qualify for a Roth, but then they can turn around and convert it to a Roth. It's called a backdoor Roth, where they start with a post-tax contribution to an IRA, convert it to a Roth, and now it grows tax-free the rest of their life. There's rules around this. Can't do it if you've got other IRAs laying around that are pre-tax, because there's a pro rata rule. There's some other stuff to worry about. So don't just jump out and do this, but it's an interesting way to consider moving money to the Roth if you don't have a bunch of these other things going on. And the other thing I'll point out is this mega backdoor Roth. Take this concept and now put it in the 401k world. If your 401k has the ability to do Roth conversions, and you'll notice this amendments needed is one thing I point out. 401k has to allow it. So if you're a business owner, you can amend your documents to allow this. But then you could do it inside the 401k with after-tax dollars. So you could contribute very large amounts of after-tax dollars to your 401k and do this backdoor Roth idea there. And now you're not stuck with these limits of 7,000 going into an IRA and converting. You could do much more than that. So there's some cool strategies. I just bring them up lightly, but I want you to at least understand that they exist if you want to get into them in more detail. The decision to do a IRA that's deductible versus a Roth IRA, or if you think about it, your 401k, which is deductible usually, versus a Roth 401k, really depends on your tax bracket. And what I try to do here is think about it from what cycle of life you're in. Oftentimes early on, and I always think of my kids because my kids are now in their early 20s, starting working. This is the time to do Roths. This is the time to really max things out because they're in very low brackets typically, right? As we advance in our careers, we start jumping into higher tax brackets as we get more successful. And then it probably makes more sense to go with pre-tax stuff like just a pre-tax IRA, your 401k or a 403b at work. So that probably makes more sense to take the tax deduction. Now, if in the middle of all that you start up a business, maybe there's a year or two where you have very little income. Again, Roths suddenly make more sense because we're assuming down the road somewhere you're going to go up in taxes from there. As the business develops, however, they're going to make less sense. As you start to get closer to retirement, if you work part-time as you get near retirement, Roths can make more sense. Early retirement, we tend to do a lot of Roth conversions to try to get money out of IRAs and 401ks into the Roth because we're typically in lower brackets early on in retirement. And then after Social Security and other things we start getting back up a little bit. So it's just a way to think about it differently. I just wanted a different way to kind of visualize. Now let's jump into something really fun, and that's minimum distributions. I mentioned this earlier, so this is a strategy to consider as we think about minimum distributions. Basically, a minimum distribution has to occur when you're 73, as I mentioned earlier. So let's take this example where we have $1 million IRA or 401k. According to the IRS tables, we have to take out about, if you do the backwards math on this, because they give us this factor of 26.5, divide that into this, and basically you figure out that it's about a 3.5% distribution rate. So it slowly goes up as you age, but 3.5 to 4%. Sorry, I bumped something. 3.5 to 4% is your distribution percentage as you age. So every December 31st, you have to look at the account balance and do this calculation and then take that amount out. So in 2025, the minimum distribution, if you use this, is 37,736 on this million. And this is standard across the board. So if you are sitting on this call with 3 million, multiply this by 3, because 37 times 3 is going to be your distribution. Anyway, so that's a really easy way to think about it. Okay. Now, one of the things to look at is whether or not we can do that differently. So let's think about this from a different angle. Instead of thinking about it just from a minimum distribution angle, let's think about it from the standpoint of spending. Because a lot of people get into retirement and they want to spend more than their minimum distribution, but they have a lot of their assets in retirement plans. So let's think about this from the perspective of $140,000 distribution, married filing jointly. If we just took all 140 this year because we know we got to spend something, and let's just pretend we're, in October, November timeframe. Say, okay, I want 140,000 out for spending over the next year. Basically, here's what happens. First 23,000, if you think back to my chart, stacks at 10%, the next dollar's at 12, and the final dollar's at 22. Add these three numbers up because these are the hard tax expenses. You'd have to spend $20,000 in tax to get your 140,000. But let's pretend it is October. What if I say, well, hang on a second. Let's do half in 1 year and half in the next year. So I'm going to go back. We'll use 2024 rates just to pretend we did this a couple months ago. Now your tax expense never gets into the 22% bracket in 24, but it also never gets there in 25, because by splitting it 70,000 each year, we can do 70 grand right, at the end of 2024. And then on January 2nd of 2025, I send another 70,000 to you. And all of a sudden you've spent 15,000 in tax. You saved yourself almost five grand. That's what we're trying to do when we are thinking through every time distributions happen. And that's why distribution planning in retirement gets more complex. Every single decision has a tax question behind it. So moving on. I mentioned this already. I'm not going to spend much time on this. I think I did mention that these dollar amounts don't index. So if you hit these dollar amounts in income, that's what creates this 3.8% Medicare tax. Now, the Medicare tax is based on a couple of different things. And it's basically on investment income. So I'm going to walk through a couple of examples here because this gets a little bit goofy. The Medicare tax applies to investment income, which is this interest, dividends, capital gains. It also applies to annuity and rental income. But what it doesn't apply to is anything where you have wages or pensions. It does not apply to IRA withdrawals or Roth conversions, and it doesn't apply to muni bond interest. This is the issue where people get messed up. So I'm going to walk through a couple examples. The 3.8% Medicare tax, I kind of got to read these examples just to make sense of it. But here we have a single person, Fred, who's got $100,000 of salary and $50,000 in investment income. So their modified adjusted gross income is 150, those two. Okay. Because these are income related, the 3.8% Medicare tax doesn't apply because 150 is less than 200. If I go back a slide, go back 2 slides. Remember, for individuals, I have to be over 200,000, for couples over 250. And of course, trusts are a different number before I have this 3.8% kick in. And then I have to have these definitions apply. So in this case, Fred doesn't pay because he falls below 200, even though he does have investment income that typically would hit that criteria. In the second example, Tony and Tina have $300,000 of salary, doesn't apply. 50,000 of IRA withdrawals, doesn't apply. 50,000 of Roth conversions, doesn't apply. And since they have no investment income, even though they went over 250 with all this, they don't pay this 3.8%. It's this fact that they have no investment income. So what we find sometimes is that people with a lot of money in IRAs and 401ks may not have this 3.8% problem as much. Now, the trade-off to that is they can still pay a lot more tax because in order to spend, they have to pull it out of something that's been pre-taxed, and now they got to pay taxes. So they sometimes force themselves into higher brackets. So this trade-off is what we got to think about. In an ideal world, I would love people to walk in the door in retirement with half their money in IRA and 401k plans and half their money in normal brokerage accounts, HSAs or Roths, because now I have tax control when I do this distribution planning. Just to play this example out a little bit, in this scenario, because this mythical client has salary, but now investment income that's high, they're way above the 250, and it's this investment income that creates the problem. And so in their case, that 3.8% applies to everything above 250, and therefore they're going to pay tax on that extra. And then I got a trust example. If you have trusts, it's a whole different animal. Let me jump down to the municipal bond question. This is going to be an interesting one because now that interest rates are higher, this actually matters. I've used this example in years past when the interest rates were at zero, and this really didn't have much of an effect, but now it does. If you had a CD that's currently paying 4.25%, which is about what today's rates are at, versus a municipal bond that's paying 3.93%, a lot of people will default to the CD because it's higher. But what you have to do is the math behind that to figure out what is the potential income tax on the interest of the CD versus the municipal bond. And what we did is we just maxed everything out and said, we're going to have maximum federal tax rates. We're going to apply that 3.8% Medicare tax rate, which, by the way, doesn't apply to municipal bonds. And then 9.85 on the state, Minnesota state. And so you end up with this tax rate of 49. So when you do the math backwards, 4.25% really is a 2.1% taxable or taxable equivalent yield, okay? Because you got to pay all this tax. So that's really what you get. But if you had to back into what the taxable equivalent yield is, because you get to keep this full 3.93, it's actually 7.9 in that municipal bond. So kind of do this crisscross here, okay? 4.25 equates to 7.9, 3.9 equates to 2.1. So in this scenario, in today's world, municipal bonds can make way more sense, particularly than they did over the last decade or 15 years when interest rates were nearly zero. Let's jump into a couple of gifting issues. As we near the end of our slide deck, I'll point out that there is a Q&A box. So if people do have questions, you're free to drop a question there. I'll try to answer it. If it's too specific, I might push it to offline. But if we look at it from a appreciated stock standpoint, what we typically are going to tell people is if you're going to make contributions to charity, cash is the last way to do it. We typically want to start with other methods first, and the main one being let's gift appreciated stock. If you think about it, let's pretend we have $10,000 worth of Apple and we have a $2,500 cost basis. So that's what we paid for it. So there's $7,500 worth of capital gain here. If we sold the stock after we pay capital gains taxes, we'd have $8,200 left to give to charity. Okay. If we look at it from, I'm not going to get into this AMT issue. If you've got AMT issues, that's a whole different answer. It's slightly worse then. But if we don't sell it and just gifted it to charity, we could give the full 10,000, and the charity, since they don't pay capital gains, never has to worry about this capital gain problem up here. So we get to deduct 10,000 for the gift here, versus if we'd sold the stock and gifted the cash, we'd only get to deduct 8,200. But that's why you always want to gift appreciated assets. And what I'll tell you is appreciated assets nowadays are all kinds of things. It could be stocks, mutual funds, ETFs, but it could be real estate. It can be private company shares. There's all kinds of ways to do this. If you really want to get more complex about it, there's some really cool ideas. So keep that in mind. The second way to do this, though, because a lot of people will say, I don't want to just give the money to my charity directly because I'd rather give them small amounts through time, is using a donor advised fund. Now, a donor advised fund is simply a brokerage account that is owned by a charity. So from a charity standpoint, and the charity, by the way, might be a public charity like the Catholic Community Foundation, or something with the Jewish Federation or something like that. But it also could be just Charles Schwab or Vanguard or Fidelity. They all have charitable arms that have these donor advised funds. So what happens with them is you can move appreciated assets or cash if you want, but appreciated assets are what we prefer over. You get the tax deduction today, but in a donor advised fund, you get to manage that asset. So what they do is they immediately sell your asset you move over, but they allow you to reinvest it in whatever you want. They just want to diversify it. So we reinvest it and keep growing it if it's enough money. But even if people just want to give it all out, they can give it all out today, or they can give it out over the next, decade for all I care. So it's a way for people to do large chunks of deductions to charity, but not have to give it out all in 1 year. And so it allows us to manage your tax brackets on your tax return better. We'll oftentimes pair ideas like this up with a Roth conversion or other income issues coming in so that we can offset the income from that with this kind of charitable deduction. So there's some cool ways to do this. And it especially is nice when people are doing something big like selling a business or, that kind of thing. So we love these things. They're easy to use. You can log on and do it at 10 o'clock at night if you want. So it's super easy. And nowadays, quite honestly, charities know all about them, and you can work with charities no problem. So love to talk more if anyone wants to about that. As I get closer to the end, I'm not going to jump into this stuff as much, but there is, if you have Social Security and you have income limits below some of these numbers, you can potentially, pay slightly less on your Social Security. Most people are not going to fall below these limits. So most people are going to pay taxes on 85% of their Social Security. It's not an 85% tax, so don't do that. There are some suggestions about not paying taxes on Social Security and at the federal level, but thus far that stuff's gone nowhere. So for now, that's the rules we live with. This is going to be one of our slides that really are going to cause you to sit up, I think, because when this hits people get angry. So the way Medicare works, we all pay a certain amount, okay? And when we pay that certain amount, we all get whatever benefits come from that. So when we turn 65, we all sign up for Part A, we get that free. Part B, however, we have to pay for, okay? And then Part D, you have to potentially pay more for. And Part D is drug coverage, by the way. So A and B are the hospital and the doctor coverages. So Part B, we all pay for. Now, a lot of us, not me, but when people pay for this, If you're not taking Social Security, you'll just get a bill for that. If you are taking Social Security, they subtract this from your Social Security distribution each month. So that's how this works. And this is per person. So if you're married, times this by 2. Okay. So for joint couples, if you fall below 212,000 a year, you're going to pay the minimum, which is this 185. Problem is, if your income starts to jump up, you start to pay more. So you have what we call a surtax. Now, the other side of that is, so does your Part D coverage jump up more. So what ends up happening here is people on accident push themselves into higher brackets. How does that occur? They sell a business. They take large distributions out of something. They may have a huge capital gain hit for something that, sell $1 million worth of Apple stock, whatever. They can force themselves into these higher brackets that cause premium shifts. And then these 2 columns, just look at the joint column. I'm totaling so that you can see the annual difference in cost here. And for someone who's bringing in, let's say $400,000, you would think, well, maybe it doesn't matter that much that they got to pay 8,000 more. But I'll tell you that people are annoyed by this more than not. So if we can avoid it, we want to avoid it. It goes into, and so what we think about when we think about taxes is we're thinking about your income tax brackets versus your capital gains brackets versus your Medicare premium brackets, because everything's different. But this we watch very closely. So I bring that up because if you're not paying attention, you'll get annoyed. The other thing is, by the way, this stuff gets reported by the IRS to Medicare 2 years late. So what happens is you're going to see your premiums jump 2 years after whatever the event was that jumped them. So what we see a lot is people that sell their business and have this huge income come in. And let's say they're up over this because they've had a couple $1 million business they sold. They get into retirement, everything's going fine. 2 years later, they get a notice from Medicare that their premiums are now this instead of this. And it causes great heartburn. Because of that 2-year lag, you can basically file a one-time exemption with them that says, hey, here's a specific scenario I had. There's a bunch of here's a list of 5 things. I forget how many there are of reasons why that occurred. And then usually we can get that mitigated. And they'll take it and say, okay, since it was a one-time deal, we'll negate this and we'll bring you back to where you're at today. Now, if they see the next year's tax return doesn't show that, by the way, all bets are off. Then you don't get to argue that every year. But we have helped people mitigate that a lot of times. So just keep that in mind. If you are doing anything big, 2 years from then, you got the shot coming. If there's any business owners on this call, and I'm going to end with these couple slides. The biggest thing through the end of the year here is this Minnesota PTE. What it basically does is it allows your company to pay your state tax for you. And then at the federal level, that's not considered taxable income. So it comes off the top for federal tax purposes. So if you're not doing this, again, if you're working with us, most people will be, but if you're working with someone else and you just haven't heard about this, feel free to reach out. This is a really interesting idea, but I have seen people not using it. So it's surprising to me because this has been in place for a while. Again, whether this were to continue or not is going to be a function of whatever the new tax bill is that passes, I'm guessing, because then this would have to get changed at the Minnesota level. And then same with QBI, this is a different answer. I'm not going to get into the details of this anymore because again, the tax bill this year may or may not change this, but for the most part, it lets certain business owners to deduct 20% of income. And so from a deduction standpoint, they don't have to pay tax on it. And that is kind of a nice deal. So for certain pass-through entities, it makes sense. Again, something to bring up with your accountant if you're not doing this. We occasionally see opportunities where people could have been doing it and they didn't. And here's one of the reasons. This is done on an income basis, so by person. So let's say you had 4 business partners, 3 of them highly comp, but one of them's like 32 years old, just came into the business, and their income isn't as high as everyone else's. They might accidentally qualify, whereas everyone else doesn't. And so you should think about it from that angle. Sometimes businesses just assume that, well, we don't qualify, but the reality is, since this is done on a per person level, some might and some might not. I'm going to leave it at that. So with that, I'm going to look for questions. And the question is the RMD age change to age 75 in 2033 occur all at once, or is it graduated over time? That's a really good question, and I don't remember the answer to that off the top of my head. So I know who's saying this, so I'll get back to them. But for everyone else, if you want to know, you're going to have to ping me. I honestly forget. Sorry about that. I don't see any other questions coming in, but what I'll tell you is next month, we're doing something kind of unique. The big talk all of a sudden in the last couple of years has been on longevity planning. And if you read certain books about how to take care of your health better, things like that, longevity planning is a term you would understand. So what we're going to do is we're going to dig into what is longevity planning from the perspective of the intersection of health, wealth, and time. Because I think it's not just about health and how long you can live, but it's also about the quality of life and the times where you have to do certain things. Not just about how long you live, but you got to do things while you're healthy. So there's a bunch of interplay there that I'm going to jump into. So if you're interested in that topic or have other people that are interested, it's something unique that I've been working on. So feel free to attend next month on that topic. And seeing no more questions, I wish everyone the best day. If you want to follow up with me afterwards, feel free to send us a message, and I'd be happy to talk. Have yourself a great day, and talk to you next month. Bye-bye.